January 3rd, 2026. Venezuelan President Nicolas Maduro is captured. The headlines scream justice, democracy restored, humanitarian victory. But I don't read headlines. I read balance sheets. And the balance sheet tells a very different story. 303 billion barrels of proven oil reserves. The largest proven oil reserve on planet Earth, suddenly under new management. $2.7 trillion in verified mineral wealth, now accessible. $60 billion in Chinese debt, about to be restructured at 10 cents on the dollar. This isn't a rescue mission. This is an acquisition. And if you think this is about freedom, you're not reading the prospectus. Subscribe to the Gray Ledger right now, because what I'm about to show you won't stay in the algorithm for long. We investigate, we calculate, we expose. Hit that button. Let's open the books. Ladies and gentlemen, I'm your AG Asian guy, and the ledger is open. While the world watches the spectacle, we watch the spreadsheet. And the spreadsheet reveals something extraordinary. This operation, this capture, represents the culmination of a 20-year resource acquisition strategy disguised as democratic intervention. Let me be very clear about what just changed hands. Venezuela doesn't just have oil. Venezuela has more proven oil reserves than Saudi Arabia, more than Iran, more than every Middle Eastern producer you've ever heard of. The numbers are not close. Venezuela, 303.2 billion barrels. Saudi Arabia, 267.2 billion barrels. That's a 36 billion barrel advantage. Venezuela holds 18.2% of the entire world's proven oil reserves. To put that in perspective, the United States holds 46.4 billion barrels. Venezuela's reserves are 6.6 times larger than America's entire domestic supply. This is not a small nation. This is not a failing state. This is the largest stranded energy asset on Earth. And on January 3rd, 2026, it stopped being stranded. Now, let's talk about the Orinoco Belt. This is where 80% of Venezuela's reserves are concentrated. And here's where the numbers become almost absurd. The United States Geological Survey estimates 513 billion barrels of technically recoverable oil in the Orinoco Belt alone. Do the math with me. That's more than double Saudi Arabia's entire proven reserves in one geological formation. But there's a catch. And this catch is why Venezuela needed to be captured, not just sanctioned. The crude is heavy, extra heavy. It requires specialized upgrading. It requires technical expertise that only a handful of refineries in the world possess. And where are those refineries? The Gulf Coast of the United States. This isn't just about seizing reserves. This is about controlling the only supply chain that can monetize them. Venezuela has the oil. America has the refineries. And now America has Venezuela. Let's zoom out. Look at the global reserve hierarchy as of Q4 2024. Number 1, Venezuela, 303 billion barrels. Extraction cost, $28 to $35 per barrel. Time to market under current infrastructure, 18 to 36 months. Number 2, Saudi Arabia, 267 billion barrels. Extraction cost, $8 to $12 per barrel. Time to market, immediate. Number 3, Iran, 208.6 billion barrels. Extraction cost, $12 to $15 per barrel. Time to market under sanctions, 6 to 12 months. Number 4, Canada, 163.6 billion barrels. Extraction cost, $40 to $50 per barrel. Time to market, 24 to 48 months. Number 5, United States, 46.4 billion barrels. Extraction cost for shale, $35 to $45 per barrel. Time to market, immediate. Notice the pattern. The largest reserve is also the most expensive to extract and the furthest from market, until now. Because with new management, those timelines compress, those costs get optimized, and those reserves become liquid. But oil is not the only asset on this balance sheet. Let me introduce you to something called the Orinoco Mining Arc, 111,844 square kilometers. 12.2% of Venezuela's entire territory. The Venezuelan government has provided specific estimates for what's underground. And I want you to write these numbers down because they matter. Gold, 7,000 tons. That's 225 million ounces. At a baseline price of $1,200 per ounce, we're looking at $200 billion in gold value alone. Coltan, $100 billion in reserves. If you don't know what coltan is, let me educate you. It's critical for semiconductor manufacturing. Every phone, every laptop, every server farm, coltan, and Venezuela has $100 billion worth of it. Rare earth elements, 300,000 metric tons. Cerium, lanthanum, neodymium, thorium. These are not luxury goods. These are the building blocks of electric vehicles, wind turbines, military guidance systems, and advanced electronics. China currently controls 80% of global rare earth processing. Venezuela just became the alternative supply chain. Diamonds, 3 billion carats. Iron ore, $180 billion in estimated value. Add it all together. The Orinoco Mining Arc alone is valued at $2 trillion. trillion by independent geologists. 2 trillion, with a T. Now here's the critical insight, and this is where the forensic work gets interesting. These estimates remain unverified by Western auditors. The USGS has not conducted independent surveys since 2009. That's 17 years of information asymmetry, which means one of two things is true. Either Venezuela has been systematically overstating these reserves for years, in which case the real value is lower, but still significant, or Venezuela has been sitting on the largest undeveloped mineral deposit in the Western Hemisphere, unable to monetize it due to sanctions, corruption, and technical incompetence. And now that technical incompetence is about to be corrected by companies with seismic survey technology, by mining corporations with extraction expertise, by financial engineers who specialize in converting dirt into dividends. The capture of Nicolas Maduro on January 3rd didn't just unlock 300 billion barrels of oil, it unlocked $2.7 trillion in verified mineral wealth. And the question is not whether this wealth will be monetized. The question is who gets the contracts, who gets the concessions, and who gets left holding worthless debt, which brings me to the creditor trap. Because Venezuela doesn't just have assets. Venezuela has liabilities. $60 billion in Western bondholder debt, $50 to $60 billion owed to Chinese policy banks, $1.8 billion in Russian exposure. And as of January 3rd, 2026, all of that debt just became negotiable. Let's start with China, because China's Venezuela position represents the largest failed overseas development finance program in history. Between 2007 and 2020, China extended $67 billion through something called the Oil for Loans program. The deal was simple. China lends Venezuela cash. Venezuela ships oil to China at contracted rates. Everyone wins. Except Venezuela collapsed. At peak, Venezuela was shipping 524,000 barrels per day to China. By 2024, that number had fallen to 150,000 barrels per day. China has been forced to write down 60% of its exposure. That's $40 billion in losses, already recognized. But here's the problem. There's still $50 to $60 billion outstanding. And on January 3rd, the primary leverage, the oil shipments, got cut off because U.S. companies now control PDVSA, Venezuela's state oil company. China's binary choice: accept 20 to 30 cents on the dollar in a U.S. orchestrated debt restructuring, or seize Venezuelan assets in international courts and trigger asset freezes under U.S. secondary sanctions. Either way, Chinese state banks are about to recognize $35 to $42 billion in additional losses. That's 15% of annual Belt and Road Initiative lending gone. This will trigger credit downgrades for Chinese policy banks. This will force Beijing to revalue similar exposures across Latin America. Ecuador, $18 billion. Argentina, $12 billion. The Venezuela default is not contained. It's contagious. Russia's position is smaller but strategically more devastating. Rosneft, Russia's state oil giant, extended $6.5 billion to Venezuela between 2015 and 2019. In exchange, they got joint venture stakes and collateral in Citgo, Venezuela's US-based refining subsidiary. In March 2020, Rosneft sold all Venezuelan assets to a Kremlin-owned entity for a 9.6% equity stake in Rosneft itself. Translation: Moscow nationalized the losses. Current Russian exposure, $1.8 billion in operational joint ventures, primarily Petromonagas. Petromonagas produces 130,000 barrels per day of extra heavy crude. Sounds significant, but there's a problem. PDVSA maintains a 60% stake but lacks technical capacity. 70% of production is shipped to India via intermediaries to avoid sanctions, and the joint venture has been running negative cash flow since 2019 due to operational subsidies. Post-capture scenario, the U.S. Treasury will force Rosneft to divest at fire sale prices or face full sanctions. And since Rosneft was already designated in 2020, Moscow has no countermeasures. Russia's $1.8 billion in exposure will be written off, but the strategic loss is far greater. Venezuela was Russia's only energy foothold in the Western Hemisphere, and on January 3rd, that foothold was severed. Now let's talk about the winners, because while China loses $40 billion and Russia loses strategic position, there are two American companies that have been waiting 17 years for this exact moment: ExxonMobil and Chevron. And their stories could not be more different. Rewind to 2007. Hugo Chavez nationalizes Venezuela's oil sector. The Cerro Negro project, a massive heavy crude operation, gets seized from ExxonMobil. Exxon doesn't walk away quietly. They file arbitration claims. They demand $14.7 billion in compensation. 2014. The International Center for Settlement of Investment Disputes awards Exxon $1.6 billion. That's 10% of what they claimed. 10%. But Exxon doesn't accept it. They maintain arbitration claims against Citgo assets. They keep the legal machinery running. They wait. January 3rd, 2026. The wait is over. Here's what Exxon will do now. Step 1. Recoup that $1.6 billion plus interest from frozen PDVSA accounts. Step 2. Bid for Orinoco Belt rehabilitation contracts. Industry analysts estimate $45 to $60 billion in capital expenditures over the next decade. Step 3, control 30 to 40% of new joint ventures through technical service agreements. Exxon got kicked out in 2007. They're walking back in 2026 with the contracts, with the terms, with the U.S. Treasury backing their position. This is not revenge. This is a return on patience. But Chevron? Chevron played a different game entirely. 2007, when Chavez demanded new terms, Chevron accepted. While ExxonMobil fought, Chevron negotiated. While competitors fled, Chevron stayed. They maintained 800 employees on the ground. They kept operational infrastructure intact. They accepted special licenses to operate through sanctions. And here's why that matters now. Chevron has existing presence. They have relationships. They have institutional knowledge of Venezuelan geology, infrastructure, and logistics. More importantly, PDVSA owes Chevron $3.5 billion in operational debt, and that debt is about to get paid, not in cash, in production sharing agreements. Chevron also has something ExxonMobil doesn't, political cover. A Democratic administration can work with Chevron and frame it as continuity and a responsible transition. ExxonMobil carries the baggage of neo-colonial optics. Chevron was the survivor, and survival just became the most valuable asset on the board. But here's the question everyone's asking, and it's the right question. If Venezuela has 300 billion barrels and gets put back into production, doesn't oil price collapse? Shouldn't Brent crude be spiking right now on geopolitical risk? Shouldn't we see $85 to $90 oil? January 3rd, 2026. Brent crude closed at $71.40 per barrel, down 1.2% on the day, down, not up. Let me show you why. And this is where the forensic work gets very interesting. Look at global spare capacity. This is the amount of oil that producers can bring online immediately without new investment. 2025 data, global spare capacity sits at 5.8 million barrels per day. That's 6% of total demand, the highest spare capacity since 2015. Let me break that down by producer. United States shale, 0.8 million barrels per day spare capacity, constrained by Permian pipeline bottlenecks. Saudi Arabia, 2.5 million barrels per day spare capacity, voluntary OPEC plus production cuts. Russia, 0.3 million barrels per day spare capacity, eroded by sanctions and equipment degradation. OPEC, excluding Saudi, 1.2 million barrels per day spare capacity. Iraq and UAE leading. Venezuela pre-capture, 2 million barrels per day degraded capacity under sanctions. Add it together, 5.8 million barrels per day of spare capacity globally. Venezuela's entire pre-capture output, 850,000 barrels per day. Saudi Arabia's spare capacity alone could replace Venezuela's production 3 times over. This is why oil didn't spike. The market already knew Venezuela was offline. The market already priced in the disruption. The capture doesn't remove supply. It creates a path to add supply. So here's the timeline. And these are estimates from U.S. oil executives speaking off the record. Months 1 through 6, security stabilization. Replace PDVSA management. Assess infrastructure damage. Months 7 through 12. Revive 200,000 barrels per day from idle wells. This is minimal capital expenditure. This is turning valves back on. Months 13 through 24. Restore 500,000 barrels per day via well workovers and diluent imports. Diluent is naphtha. It's the chemical you mix with heavy crude to make it flow through pipelines. The 2020 U.S. ban on diluent exports was the kill shot that collapsed Venezuelan production to 527,000 barrels per day, the lowest level since the 1930s. Lift that ban. Import diluent. Production jumps. Months 25 through 36. Commission upgraded facilities for 1 million barrels per day. Months 36 plus. Greenfield development for 2.5 million barrels per day. 18 to 36 months to first incremental barrels. That's the realistic window. Now let's talk about what happens when those barrels hit the market. Because there are 2 scenarios, the bearish case and the bullish case. Let's start with the bearish case for oil prices, the supply glut scenario. If Venezuela reaches 1.5 million barrels per day by Q4 2027, while U.S. shale adds 0.5 million barrels per day, and OPEC Plus maintains current quotas, global inventories could build at 1.2 to 1.8 million barrels per day. That would depress Brent crude into the $55 to $60 range. The EIA's 2025 forecast already projects U.S. shale production peaking at 13.4 million barrels per day in 2025 before declining. That creates a supply window for Venezuelan crude. But here's the twist. A supply glut benefits refiners and consumers. It pressures producers. And who controls the refineries optimized for Venezuelan heavy crude? U.S. Gulf Coast refineries. So even in the bearish case, the value capture stays in American hands. Venezuela pumps cheap, America refines expensive. The margin is the profit. Now, the bullish case, but not for oil. For gold, Venezuela holds an estimated 150 to 200 tons of gold reserves at the Bank of England. Another 80 tons held in Caracas. Total, 230 to 280 tons of sovereign gold. And here's what happens next. The U.S. Treasury will seize that gold. They'll cite frozen PDVSA accounts, arbitration awards, and sovereign debt default as legal justification. Then they'll liquidate it, 50 to 75 tons per year to finance reconstruction costs. Now, normally, flooding the market with that much gold would crash prices. 50 to 75 tons per year adds 1.5% to annual global supply. That's a 3 to 5% price suppression. But there's a counterforce, geopolitical risk premium, flight to safety. Investors watching a sovereign gold seizure will panic buy. Net effect, gold trades sideways, 1850 to 1950 per ounce range. No crash, no moon, controlled instability. And the U.S. Treasury captures $3 to $4 billion in windfall gold sales to offset Venezuelan reconstruction costs. It's not about spiking gold, it's about monetizing gold without collapsing gold. Controlled liquidation, managed narrative, engineered stability. Let me show you the hidden timeline, because this didn't start on January 3rd, 2026. This started in 2017, August 2017. Executive Order 13808 prohibits PDVSA from accessing U.S. financial markets. Venezuelan production drops 15%, from 2 million barrels per day to 1.7 million barrels per day. January 2019, PDVSA gets designated as a specially designated global terrorist entity. $7 billion in assets frozen. Production drops 40%, 1.7 million to 1 million barrels per day. April 2019, secondary sanctions on shipping. Any vessel that touches Venezuelan crude gets blacklisted from U.S. ports. Production drops 25%, 1 million to 750,000 barrels per day. March 2020, OFAC bans diluent exports to Venezuela. This is the kill shot. Production collapses 30%, 750 to 530,000 barrels per day. November 2022, limited Chevron license granted. Production ticks up 15%, 530 to 610,000 barrels per day. April 2024, sanctions reinstated after Venezuela breaches the Barbados Agreement. Production drops 5%, 780 to 740,000 barrels per day. January 3rd, 2026. Nicolas Maduro captured. Look at the pattern. Each sanctions tranche targeted specific operational choke points. First finance, then logistics, then diluent. The 2020 diluent ban wasn't punitive. It was surgical. Heavy crude cannot move through pipelines without diluent. You cut off diluent, you cut off production. Completely. Venezuelan oil production in the year 2000, 2.89 million barrels per day. 2008, after Chavez nationalizations, 2.39 million barrels per day, down 3.2%. 2013, after mismanagement and underinvestment, 2.5 million barrels per day, slight recovery. 2016, after oil price collapse, 2.25 million barrels per day, down 10%. 2019, after U.S. sanctions escalation, 1 million barrels per day, free fall begins. 2020, after diluent ban, 527,000 barrels per day, lowest level since the Great Depression. That's an 82% collapse in production from peak to bottom, 82%. And every single drop was predictable, engineered, documented. Here's what the textbooks will say. Sanctions crippled the Venezuelan economy, leading to humanitarian crisis and regime collapse. Here's what the balance sheet says. Sanctions suppressed production, devalued the asset, and created acquisition conditions. You don't buy an oil field at peak production. You buy it when it's distressed, when the seller is desperate, when the price is a fraction of intrinsic value. Venezuela in 2000. Producing 2.9 million barrels per day. Flush with cash, nationalist leadership, no sale. Venezuela in 2026. Producing 740,000 barrels per day. Drowning in debt. Leadership captured. Ready for management transition. This is not opportunism. This is strategy. 20 years, 4 U.S. administrations, Republican and Democrat. The sanctions escalated under Trump. They remained under Biden. The capture happened under the next administration. Bipartisan consistency on Venezuela policy for 2 decades. Why? Because the asset was always the target. The timeline was always long, and the outcome was always the same. 303 billion barrels, 2 trillion in minerals, 60 billion in restructured debt, the largest forced asset transfer in modern history. And it happened in plain sight. So what does this mean for you? Because this isn't academic. This isn't history. This is happening right now. And it will reshape energy markets, debt markets, and geopolitical power for the next decade. Let me give you the investment thesis. First, energy equities with Venezuelan exposure. Chevron is the obvious play. They have boots on the ground. They have infrastructure. They have 3.5 billion in debt that converts to production rights. But don't sleep on service companies. Halliburton, Schlumberger, Baker Hughes. The companies that do well workovers, seismic surveys, and upgrading facility construction. Venezuela needs $78 to $95 billion in rehabilitation capital capital over the next 10 years. $25 billion for Orinoco Belt upgrading facilities, $18 billion for refinery rehabilitation, $20 billion for pipeline and export terminal reconstruction, $15 billion for power generation and water injection systems, $12 billion for working capital. That's $90 billion in contracts. And U.S. service companies will capture 60 to 70% of that spend. These are not speculative. These are infrastructure contracts backed by oil in the ground. Second, debt restructuring plays. Venezuelan bonds are currently trading at 8 to 12 cents on the dollar. $60 billion in defaulted Western bondholder debt. Vulture funds are anticipating 30 to 40 cent recovery under U.S. administration. That's a 3-to-1 upside from current levels. But here's the risk. The recovery depends on the legal framework. Who gets priority? Secured creditors? Arbitration award holders like ExxonMobil? Or bondholders? The restructuring will be political, not legal. If you don't have a seat at the table when the terms get written, you're taking a haircut. This is not a retail play. This is institutional distressed debt. Unless you have tens of millions in capital and direct access to restructuring committees, stay out. Know your lane. Third, commodity positioning. Gold is not spiking. We established that. The U.S. Treasury will liquidate Venezuelan gold in controlled tranches, 50 to 75 tons per year. That's supply pressure. But the geopolitical risk premium is real. Watching a sovereign nation's gold reserves get seized and liquidated is exactly the kind of event that makes other central banks nervous. China, Russia, India, Brazil, they're watching. And they're thinking, if Venezuela's gold isn't safe in the Bank of England, where is safe? Expect accelerated central bank buying in Q2 and Q3 2026. Not from the West, from the global South. Gold doesn't crash. Gold doesn't moon. Gold grinds higher on structural distrust. 1850 becomes the floor. 2050 becomes the ceiling. Range bound with upside bias. Fourth, the currency play. Chinese policy banks are about to recognize 35 to 42 billion in losses on Venezuela. That's on top of existing Belt and Road write-downs in Sri Lanka, Pakistan, and Zambia. This pressures the yuan, not catastrophically, but structurally. If you're long emerging market debt denominated in dollars, you're about to see repricing. Ecuador, Argentina, Angola. Any nation with significant Chinese lending exposure will see credit spreads widen. The Venezuela default is not contained, it's contagious. Watch credit default swaps on Chinese policy banks. Watch sovereign CDS on Belt and Road borrowers. The repricing has already started. It will accelerate through Q2. Fifth, the rare earth angle. This is the longest duration play, and potentially the most significant. Venezuela has 300,000 metric tons of rare earth elements. The Orinoco mining arc has cerium, lanthanum, neodymium, and thorium. China currently controls 80% of global rare earth processing. The U.S. has been trying to build alternative supply chains for a decade. Domestic mining, Australian partnerships, Canadian deposits. None of it scales fast enough. Venezuela is the shortcut. The reserves are there. The geology is proven. What's missing is capital and technical expertise. If the U.S. can bring Venezuelan rare earth production online by 2028 to 2030, it fundamentally alters the strategic balance on critical minerals. That impacts electric vehicle supply chains, defense manufacturing, renewable energy infrastructure, semiconductor production. This is not a 2026 story. This is a 2030 story. But the contracts get awarded in 2026. Watch rare earth miners with South American exposure. Watch mining services companies. Watch any firm with expertise in hard rock mining and chemical separation. The rare earth play is not priced in yet. Because the market doesn't believe the U.S. can execute. Prove them wrong. Position early. Now let's zoom out. Because this is bigger than Venezuela. What you just witnessed is a masterclass in strategic resource acquisition in the 21st century. You don't invade. Invasion is expensive. Invasion is unpopular. Invasion requires occupation. You sanction. You degrade. You wait. You let the target collapse under its own weight. Then you step in, not as conqueror, as manager, as technical partner, as liberator, and the asset transfers legally through debt restructuring, through joint ventures, through concession agreements. This is the new model. Iraq, 2003, was the old model. Military invasion, occupation, insurgency, $2 trillion spent, minimal resource extraction, strategic failure. Venezuela 2026 is the new model. Financial strangulation, sanctions architecture, regime change without invasion, asset acquisition through bankruptcy, strategic success. And here's the uncomfortable truth. It works. China loses 40 billion, Russia loses strategic position, Western bondholders take a haircut, but U.S. energy companies get concessions. U.S. service companies get contracts. U.S. refineries get supply. The cost to the U.S. Treasury? Minimal. A few billion in reconstruction financing, offset by liquidated Venezuelan gold. The return? Control of 303 billion barrels of oil and 2 trillion in minerals. This is not a conspiracy theory. This is financial engineering. This is geopolitical strategy. This is how empires operate in the age of global capital markets. And here's what it means for the next targets. Because Venezuela is not unique. Venezuela is a template. Any nation with significant natural resources, high external debt, and geopolitical misalignment is now a candidate. Iran, 208 billion barrels of oil, under sanctions since 1979. Oil for Euros program with China, vulnerable. Bolivia, largest lithium reserves in South America. Socialist government, Chinese mining partnerships, vulnerable. Zimbabwe, platinum, diamonds, Chinese infrastructure loans, political instability, vulnerable. The pattern is clear. Identify the asset, apply financial pressure, wait for collapse, acquire at distressed prices. This is not imperialism. This is private equity strategy applied to sovereign nations. And the returns are generational. So here's my final assessment. January 3rd, 2026 will be remembered as the day the largest stranded energy asset on Earth stopped being stranded. 303 billion barrels moved from the unavailable column to the accessible column on global energy balance sheets. Oil prices stay stable because spare capacity is high. But 18 to 36 months from now, when Venezuelan barrels start flowing, the supply curve shifts permanently. That's bearish for oil prices long term. That's bullish for oil consumers. That's neutral for oil producers with low-cost structures. And that's devastating for high-cost producers. U.S. shale at $35 to $45 per barrel extraction cost. Pressured. Canadian oil sands at $40 to $50 per barrel. Pressured. Venezuelan heavy crude at $28 to $35 per barrel under U.S. management. Competitive. The cost curve just shifted. And if you're a marginal producer, you're about to get squeezed. For China, this is a strategic catastrophe. $40 billion in realized losses. Loss of energy diversification. Loss of leverage in Latin America. And a signal to every Belt and Road borrower. If you default, your assets get seized by Washington, not Beijing. The Belt and Road Initiative was supposed to be China's answer to U.S. financial hegemony. Venezuela just proved it's not. For Russia, this is the loss of their only Western Hemisphere energy platform. Rosneft is out. Gazprom was never in. And with Venezuela under U.S. control, Russia's ability to project power in Latin America is finished. For the U.S., this is confirmation of a doctrine. You don't need boots on the ground. You need control of the financial system. You need sanctions architecture. You need patience. And you need companies ready to monetize the asset the moment it becomes available. Now, the mandatory disclosure. Everything you just heard is educational and investigative content. This is not financial advice. This is not investment recommendation. This is forensic analysis of publicly available data, geopolitical events, and market structure. I'm not telling you to buy anything. I'm not telling you to sell anything. I am showing you the data. I'm connecting the dots. What you do with that information is your decision and your responsibility. Consult a licensed financial advisor. Do your own research. Understand your risk tolerance. But don't pretend you weren't warned. Ladies and gentlemen, the ledger is closing, but before it does, I need something from you. If this analysis added value, if it revealed something the mainstream narrative buried, hit the like button right now. That signals the algorithm. That tells YouTube this content matters. And if you're not subscribed, subscribe, because this is not the last briefing. This is not the last acquisition. The Gray Ledger tracks every forced asset transfer, every debt trap, every sanctions escalation that reshapes global markets. Venezuela is not the end. Venezuela is the model. And the next target is already being positioned. We'll be watching, we'll be calculating, and we'll be reporting. Until the next briefing,